Investing successfully doesn't require exceptional intelligence, access to insider information, or relying on luck. What truly matters is having a solid intellectual framework for decision making and the ability to keep emotions from clouding judgment. Benjamin Graham, in his book The Intelligent Investor, offers such a framework and provides logical principles to help control emotions. It can be argued that his investment strategy has been among the most successful over the past century. The remarkable achievements of Graham himself and his numerous followers cannot be overlooked. One standout disciple is Warren Buffett, currently the third wealthiest person in the world, who considers this book to be the absolute best written on investing. In this video, I will share my perspective on the most valuable insights from this remarkable book. But before we make a move, do subscribe to our channel and stay updated for more insightful content. Let's get started. Takeaway number 1. Meet Mr. Market. Imagine you own a part of a business that you acquired for $1,000. Every day a character named Mr. Market visits you, offering his opinion on the value of your ownership stake. Interestingly, Mr. Market is a rather unpredictable individual. In the past, he has made absurd estimates like valuing your share at $2,600 in March 2000, only to drop it to $500 in March 2001. Meanwhile, during that period, the company's income grew by 50% and profits increased by 20%. Mr. Market's opinions can be nonsensical. Graham emphasizes that a stock is more than just a symbol and a price. It represents actual ownership in a business. Since Mr. Market can be irrational, the true value of the business may differ from the price he suggests. Often, he becomes excessively optimistic or pessimistic, leading to overvaluation or undervaluation. Graham advises investors to make their decisions based on the underlying value of the business, without getting swayed by Mr. Market's fluctuating prices. Graham suggests investing only in stocks that you would be comfortable holding for the long term, regardless of Mr. Market's daily offerings. However, for those who can remain composed, Mr. Market provides an opportunity to make profits. He doesn't force you to make a deal, he simply presents you with options. If he offers an extremely high price, it's wise to sell, and if he presents a bargain, it's advantageous to buy. It's important to note that when Graham wrote his book, people had fewer sources of information compared to today. In the 1970s, Mr. Market visited just once a day, accompanied by the morning newspaper. Nowadays, he approaches us every time we check our phones, which may happen over 100 times a day. However, the frequency of Mr. Market's visits doesn't mean we should trade with him more often than in the past. If his offers don't meet your standards, it's best to ignore him and carry on with your day. Takeaway 2. Invest as a defensive investor. Graham classified investors into two types: defensive, passive, and enterprising, active. The majority of individuals are better suited for the defensive approach due to the limited time available for investing. A defensive investor should construct a portfolio comprising a balanced blend of stocks and bonds, such as 50% in each category. It is important to adjust the allocation periodically, usually once or twice a year. For instance, if stocks suddenly constitute 60% of the portfolio while bonds only make up 40%, stocks should be sold and bonds purchased until the 50-50 ratio is restored. This strategy ensures the portfolio remains aligned with the desired allocation. Implementing dollar-cost averaging is another valuable approach. Regularly invest a fixed amount of capital, ideally immediately after receiving your salary. This technique, known as dollar-cost averaging, allows for purchasing stocks and bonds at various prices, resulting in a fair average cost over time. It also prevents the concentration of purchases during unfavorable market conditions. Regarding the stock component, the defensive investor should aim for the following criteria. 1. Diversify investments among 10 to 30 companies, avoiding overexposure to a single industry. 2. Focus on large companies with yearly sales exceeding $100 million, adjusted for inflation, approximately $700 million in today's value. 3. Select companies with conservative financing, characterized by a current ratio of at least 200%. This means that current assets should be at least twice the size of current liabilities. 4. Consider companies that have consistently paid dividends to shareholders for at least the past 20 years. 5. Look for companies with no deficit in earnings over the last 10 years. 6. Seek companies with a minimum earnings growth rate of 33% during the past 10 years, reflecting conservative annual growth of 2.9%. 7. Avoid overpaying for assets by ensuring that the stock's price does not exceed 1.5 times its net asset value. Net asset value can be calculated by subtracting the company's liabilities from its assets. 8. Avoid overpaying for earnings by keeping the price to earnings P to E ratio below 15, based on the last 12-month earnings. Alternatively, investing in an index fund is an option, as it provides returns similar to the market average. If you are satisfied with the average returns, the two key takeaways mentioned earlier are sufficient. However, if you desire more, additional considerations should be taken into account. Takeaway 3. Invest as an enterprising investor. The defensive investor has it relatively easy when it comes to achieving average market returns. It may seem like beating the market is a simple task that requires just a bit more time and effort than what average investors put in. However, being an enterprising investor and outperforming the market is a much more challenging endeavor, as this line of thinking suggests. It demands qualities like patience, discipline, a thirst for knowledge, and a significant amount of time. Many professionals and individual investors find themselves ill-suited for this approach and often fall prey to the whims of Mr. Market's price fluctuations more than they could ever imagine. Consider the following statements made by the chief investment strategist at two large mutual funds during the dot-com bubble's peak in the early 2000s. 1. It's a new world order. 2. We see people discard all the right companies with all the right people with the right visions because their stock price is too high. These statements turned out to be costly for the investors who entrusted their money to these funds. While the strategist argued that the stock market wasn't riskier despite the soaring prices, the reality proved otherwise. Yes, the stock market has become riskier as prices have risen. As an intelligent investor, one should recognize that the profits a company can earn are finite, and therefore, the price one should be willing to pay for such companies must also have its limits. Price is a crucial factor for the enterprising investor. The market tends to overvalue companies experiencing rapid growth or having glamorous appeal while undervaluing those with unsatisfactory progress. Consequently, the intelligent investor should be cautious of so-called growth stocks. Why? Because their investment decisions rely more heavily on future earnings, which are inherently less reliable than current valuations. On the contrary, if you can find a company that is valued lower than its net working capital, you can essentially acquire all fixed assets, such as buildings, machinery, and goodwill, for free. The net working capital can be determined by subtracting total liabilities from current assets. Graham found such companies to be genuinely profitable during his investment career. Unfortunately, they are rare in today's market, except during challenging bear markets. Fortunately, Graham offers additional methods for finding investments suitable for enterprising investors. These criteria align with those recommended for defensive investors, but with more flexibility, allowing the enterprising investor to consider a broader range of companies. Note that company size is no longer a constraint. Diversification should still be applied, although the exact number of companies held is not set in stone for active investors. In the analysis of a company, the enterprising investor should also dedicate time to studying its annual financial reports. Graham has extensively covered this subject in his book, The Interpretation of Financial Statements. We can delve deeper into this topic on another occasion. Takeaway 4. Insist on a margin of safety. Minimizing the risk of being wrong is a crucial aspect of investment. To achieve this, it is essential to ensure that every investment has a sufficient margin of safety. It's important to recognize that the price of the company does not always align with its true value. When the price is no more than 2/3 of its calculated value, an investor has identified a company with an acceptable margin of safety. Consider this analogy. Just as you wouldn't build a ship that could sink with 31 Vikings on board, when you know it will regularly transport only 30, similarly, you should avoid investing in a stock that you believe is worth $31 when it is currently priced at 30. In both cases, the consequences could be unfavorable. In the first scenario, a group of disgruntled and wet Vikings might come after you, while in the second, your path to financial freedom may be delayed by a couple of years. It's challenging to determine which situation is worse, so it's wise to employ margins of safety. A useful formula from the book provides insights into determining the value of a company and whether it can be purchased with an adequate margin of safety. The formula is as follows. Value equals current, normal, earnings times 8.5 plus 2 times expected annual growth rate. The growth rate should reflect the anticipated yearly earnings growth for the next 7 to 10 years. Let's examine the valuations of the 3 largest companies in the S&P 500 according to this formula in September 2018. It's worth noting that we can also use the formula in reverse to assess the level of growth these companies must achieve in the next 7 to 10 years for the current stock prices to be rational. Astonishingly, there is a significant discrepancy here. Amazon is expected to grow at a rate of 74% per year based on its stock price, whereas Apple is projected to grow at a mere 5.8%. Do you find this difference reasonable? Takeaway 5. Risk and reward are not always correlated. According to academic theory, the relationship between an investor's expected rate of return and the level of risk they are willing to accept is proportional. Risk is typically measured as the volatility of investment returns, indicating the historical deviation from the expected value. However, Graham challenges this notion by asserting that the price and value of assets often diverge. Therefore, an investor's expected return is influenced by the time and effort they invest in identifying undervalued assets. The minimum return is associated with a defensive or passive investor, while the maximum return is attainable by an enterprising investor who applies intelligence and skill. Imagine this scenario. It's 4 a.m. and you and your friends have been enjoying a night out on the streets of Moscow. Deciding it's too early to call it a night, you venture into the less familiar parts of town. In a rather ambiguous bar, a man approaches you and poses a question. Would you like to play a game? Intrigued by the idea of games, your most courageous and least sober friend responds. The man places a spinning revolver on the table containing a single bullet. I'll give you $10,000 if you dare take a shot. Russian roulette, the man offers. Your intoxicated friend reaches for the gun, but you intervene, stopping him. We'll pass on this one, you politely inform the man. I thought so, he responds, with a knowing smile. What about $100,000 for taking 2 shots? This story illustrates the academic approach of demanding a higher potential reward in exchange for assuming a greater risk. In the initial offer, you were to receive $10,000 with a 16.7% chance of a fatal outcome. In the second offer, the reward increased to $100,000 as the risk of a tragic outcome escalated to 33.3%. This reasoning appears logical, right? However, stock market investing does not necessarily follow this pattern. It's important to remember that price and value are not synonymous. When you purchase a company at 60 cents on the dollar, you encounter a promising potential reward with relatively low risk. Moreover, if you discover another company available at 40 cents on the dollar, you encounter an even better potential reward combined with an even lower risk. How could anyone reasonably argue that buying a dollar at the price of 40 cents is riskier than acquiring it at 60 cents simply because the potential reward is higher? In summary, Graham challenges the conventional view by emphasizing the importance of identifying undervalued assets. By purchasing assets at significant discounts to their intrinsic value, investors can potentially secure higher returns while minimizing risk. This perspective highlights the significance of conducting thorough research and exerting effort in the pursuit of finding lucrative investment opportunities. Here are the key insights from Graham's advice. 1. Market sentiment. The market tends to swing between excessive optimism and pessimism. Don't let these fluctuations dictate your perception of asset values. Instead, view them as opportunities to capitalize on others' uninformed decisions. 2. Diversification. For defensive investors, a balanced portfolio of stocks and bonds is recommended. Stocks should primarily consist of low-priced options to mitigate risks. 3. Value investing. Enterprising investors should seek stocks exhibiting lower price tendencies. Identifying companies trading below their net working capital could lead to lucrative investment opportunities. 4. Margin of safety. The intelligent investor must insist on a margin of safety when acquiring assets. This approach involves purchasing assets at prices significantly below their intrinsic value, providing a buffer against potential losses. 5. Risk and reward. Risk and reward do not always go hand in hand. High-risk investments may not necessarily yield commensurate rewards, challenging conventional wisdom. Reflecting on Graham's advice, it remains relevant in this present era. The market still experiences bouts of irrational exuberance and pessimism, making it crucial to remain level-headed. Feel free to share your thoughts on Graham's advice and its applicability today. If you would like a summary of another investing, personal finance, or money management book, or if you want a deeper exploration of any particular takeaway, don't hesitate to let me know. Thank you for watching.